Well, good afternoon, and thank you for joining us at today's Special Purpose Credit Program Forum. I'm Gravetta Gardenier, Senior Deputy Comptroller for Bank Supervision Policy at the Office of the Comptroller of the Currency. On behalf of the OCC, the Department of Housing and Urban Development, the Consumer Financial Protection Bureau, and the Federal Housing Finance Agency, I am pleased to welcome those attending in person and virtually. In February of 2022, the 4 agencies represented here today, along with others, released a joint statement to remind creditors of the ability under the Equal Credit Opportunity Act and Regulation B to establish special purpose credit programs. Our agencies are joined today by a variety of stakeholders to hear perspectives and thoughts on how special purpose credit programs can be a tool to address persistent disparities in home ownership rates. I am pleased to be joined by soon-to-be 4, currently 3 principals, each of whom is committed to continuing to support lenders interested in offering special purpose credit programs. I'd like to introduce each of our principals who will provide short remarks before we turn to our moderated panel. I'll begin by recognizing Secretary Marcia L. Fudge, the 18th Secretary of the U.S. Department of Housing and Urban Development. Secretary Fudge has committed to making home ownership and the security and wealth creation that comes with it a reality for more Americans. In December of 2021, HUD issued guidance addressing special purpose credit programs that clarified the relationship between the Equal Credit Opportunity Act and the Federal Fair Housing Act. Next, I'm pleased to introduce Acting Comptroller of the Currency, Michael J. Sue. Acting Comptroller Sue has made supporting a fair and inclusive financial system a priority for the OCC, as demonstrated by the agency's work with Project REACH and the Community Reinvestment Act modernization rulemaking. As of today, a number of national bank mortgage lenders have launched special purpose credit programs that target historically disadvantaged communities and populations. I'm also pleased to welcome Director Rohit Chopra from the Consumer Financial Protection Bureau. Under Director Chopra's leadership, the CFPB issued a December 2020 advisory opinion that offered regulatory certainty regarding several important aspects of the Equal Credit Opportunity and Regulation B requirements for special purpose credit programs implemented by for-profit organizations. And last, but certainly not least, I'm happy to have with us today Director Sandra L. Thompson of the Federal Housing Finance Agency. Under Director Thompson's leadership, the FHFA established the Equitable Housing Finance Plan program, which she noted, and I quote, represents a commitment to sustainable approaches that will meaningfully address the racial and ethnic disparities in home ownership and wealth that have persisted for generations. At this time, I'd like to recognize our principals for their brief remarks. Secretary Fudge, please begin.
Thank you so very much. Thank you all very much for being here. And a special thank you to my colleagues, Acting Comptroller Sue from Federal Housing Finance Agency, Director Thompson, and from the Consumer Financial Protection Bureau, Director Chopra, and all of those involved in making today possible. I have been excited about today, so I'm looking forward to our discussion as we go forward. It is nice really to be here with so many industry leaders, advocates, and stakeholders who believe, as I do, that wealth building opportunities should be available for all, especially those who have historically been left behind and left out. As Secretary of HUD, I spent a lot of time thinking about housing, obviously, how affordable it is, how much of it we have, and what it takes to access it. What strikes me most is the fact that it has been 55 years since the Fair Housing Act was passed, but the racial home ownership gap is still one of the biggest inequities in the United States. To me, that means we have some work to do. I'm glad to be a part of an administration that isn't afraid to do the work. an administration committed to closing the racial wealth gap and advancing racial equity. That touches on a lot of our work at HUD, but today we are focused on our work related to special purpose credit programs. We see special purpose credit programs as a powerful tool that can be used to close the racial wealth gap, to provide homeownership opportunities to those who have been shut out. Historically, there has been some concern that these programs run afoul of our nation's fair housing laws. So early in my tenure as secretary, HUD issued a legal opinion making it clear that special purpose credit programs generally do not violate the Fair Housing Act. With that in place, our Office of Fair Housing and Equal Opportunity called on lenders to review existing and historic barriers to credit and homeownership facing people of color and underserved communities, and establish special purpose credit programs that are consistent with our anti-discrimination laws to bridge those gaps and help first-generation and first-time home buyers access the market. We believe putting resources towards programs to expand access to home ownership and wealth building is not just legitimate, it is necessary. I know several banks and lenders have already implemented programs to bring more home ownership opportunities to underserved people and communities of color, and I applaud those efforts. But we are here today because there is more work to be done. I look forward to the robust conversation that is about to take place, and I especially look forward to the work this convening will inspire. It is not impossible to close the racial wealth gap, to expand opportunities. What we need is the will to get it done. I hope we all find that will so that we can do what is necessary to ensure that everyone can have a fair shot at the American dream of home ownership. Thank you.
Thank you, Secretary Fudge. I would also like to welcome everyone to today's Special Purpose Credit Program Forum. I'm particularly pleased to be able to co-host this forum because it focuses on an issue that's been one of my top priorities as acting comptroller, and that's addressing inequality in banking. Inequality in the U.S. has been trending in the wrong direction for too long. While there have been some hopeful signs with recent gains in employment and wages, the wealth and income gap between whites and non-whites remains substantial and persistent. A recent report from the Federal Reserve Bank of St. Louis on the state of U.S. wealth inequality included the average inflation-adjusted wealth for Black, Hispanic, and white households in the first quarter of 2023. In short, Black families have 24 cents, and Hispanic families have 23 cents, respectively, for every $1 of white wealth. Similar disparities exist for household income by race and ethnicity. In 2021, median income for white households was $77,000. However, for Black households, the median income was $48,000, and Hispanic households was $57,000. To address these gaps, progress is needed on multiple fronts. Each of the four agencies represented here today has committed to addressing inequality and has done a lot to foster and promote innovative solutions within the scope of their respective jurisdictions. This includes ongoing efforts to modernize and strengthen the CRA, ensure fair lending, eliminate appraisal bias, revitalize MDIs, and reduce barriers to financial inclusion. To really move the needle, though, and to make a sustained difference, solutions need to be able to scale. This is why special purpose credit programs are so critical. They provide a clear path for financial institutions, community organizations, and other stakeholders to develop targeted solutions to the wealth gap problem and to scale them quickly. There's a problem, though. Many banks have been hesitant to launch SPCPs. Initially, this was due to uncertainty about whether such programs would violate ECOA or the Federal Housing Act. The OCC worked with HUD, FHFA, and the CFPB on public statements to put those fears to rest. Today, with the heads of all four agencies gathered here together, we can reassure all lenders that we strongly support the development of SPCPs and that such programs can be done in compliance with ECOA. From my perspective, the biggest barrier to widespread SPCP development and adoption today is inertia. The will, the ideas, and the solutions are out there. We're going to hear about some of these shortly. My hope is that this event helps to overcome that inertia and change the trajectory of SPCPs, from being a curious initiative launched intermittently by a bank lender here or there, to being an integral part of the economic landscape, encouraging and enabling innovative targeted solutions to the wealth gap to scale and to make a real difference. I look forward to hearing from the panel at today's roundtable on their views of programs that have been launched in the market, where there might be opportunities to expand mortgage-related SPCPs to continue the effort to address historical disparities in home ownership. Thank you.
Well, thank you everyone for being here. It's so great to see so many familiar faces. I really think the Secretary has laid it out pretty clear in the final sentences of what she just said. Is there a will to do it? It's been a few years now since we've started to hear a lot about commitments being made. And I think it's now time to see if those commitments were just talk or if they're going to turn into action and to numbers that we can see. I want to make sure that we have been able to communicate clearly where there might be issues and questions you've had about the regulatory contours of pursuing this. But I really think, as the acting comptroller has said, we've really done that heavy lifting. We've repeatedly and routinely tried to explain that under the Equal Credit Opportunity Act and Regulation B, there is indeed quite a bit of flexibility, quite a bit of opportunity for lenders to be able to design and customize programs, including by providing assistance with down payments, reduced interest rates, and so many more. And I gotta be honest with you, I think we're starting to wonder, some of us, whether the industry is moving the goalposts. We need to understand very, very clearly, is there another impediment that's not about regulatory compliance? What are the obstacles, and is it really just about a lack of will? I hope that having the four of us here to communicate in unvarnished terms that we do believe that this plays a very critical role in the entire housing finance system, in the entire banking system, and that there will be movement sooner rather than later. I think, as the acting comptroller and the secretary have just shared, we don't really have great data to show on progress recently. It's not just about special purpose credit programs, it's about broader issues when it comes to inequality and inequities in the housing and financial system. So this is the start. I'm actually really eager to hear more about what is going to be the progress that we will see. The acting comptroller has mentioned the Community Reinvestment Act. That is another sign that we have to recall that banking and lending is not just any old private business. It's the plumbing of our society. And when it is cutting off power and opportunity to so many people in our country, we have to know that it's not working, and we're doing a lot to turn that grid back on. So thank you again for hosting. Thank you, Gravetta and team. And let's make sure that this is not just a place of talk, but that it is leading to actual action.
Great, thank you. And I'm going to echo everything that my colleagues have said. And I think they stole my notes because every single point I was going to make has been covered, but I do think it warrants repeating. I do appreciate everyone coming out to be here today. As has been stated, I think we all know that the racial homeownership gap is as wide today as it was in the 60s when discriminatory practices were still legal, and I was hoping 2 years into my term that I would not have to say that or continue to say that. We just feel that it's critically important to make sure that we're using every single tool in our toolbox to close that gap. Now, we believe that the special purpose credit programs have an important role to play in that effort. And as you all know, these programs allow you to target lending in the most vulnerable communities and places where access has been either prevented, prohibited, or limited. Now, currently, we serve as the regulator for Fannie Mae, Freddie Mac, and Conservator, and also the regulator for the federal home loan banks. And Fannie and Freddie both have designed special purpose credit programs that contribute to borrower down payment needs, and they're being offered currently by certain lenders in certain markets. And earlier this year, even though we started those programs at the end of 2022, we're just starting to see some of the first loans close through these special purpose credit programs. You know, we do expect the enterprises to continue to work with lenders to adopt and offer these SPCPs, as well as making sure that they're providing liquidity to support other lender programs. And I highlight that because while the enterprises do have their own special purpose credit programs, we know that other lenders, and I see many to my left, have developed their programs, and in many cases, they are eligible for purchase by both Fannie Mae and Freddie Mac. And I should take this opportunity to introduce our head of single family for purchases for Freddie Mac, and I think Fannie Mae's in the room someplace. But if you're a lender, please don't leave the room without talking to these people. We also, in addition to Fannie and Freddie, the home loan banks have actually started initiatives to engage in special purpose credit programs, and we're excited about that. I know that we also have a number of lenders and other market participants here who've launched the special purpose credit programs, and we've talked about them extensively with the enterprises. But as Director Chopra said, you know, we haven't seen a lot of activity. We have the programs, they're there. We just haven't seen a lot of movement, and I really want to understand if there are regulatory barriers to implementing and executing. Having the desire to establish and want to do the right thing is different than actually having the will to execute. So I really want to make the distinction between desire and will. I know that when we first started talking about SPCPs, some of the sellers were nervous about using them, even though all four agencies who have regulatory authority over sellers, servicers, lenders, banks, we have worked together individually, collectively, to issue guidance on this issue. So we're encouraging everyone to work together and do as much as you can when it comes to utilizing these programs. FHFA is going to continue to work with our regulated entities and anybody else who has ideas on how we can actually move the needle. Because again, as Director Chopra and Secretary Fudge and Comptroller Sue said, we really want to move the needle. We want to do what it takes to make home ownership a reality for all who choose that route. And so safe, decent, and affordable housing is the American dream, and we want to make sure that we are removing impediments and moving towards making sure that everybody has access to that dream. Thank you.
So I don't know about you all, but that was inspiring. Thank you, all four of you, for those wonderful comments and remarks. So I'd like to move to our moderated panel. And I'd like to introduce our moderator, Tamara King, Vice President of Residential Policy and Member Engagement at the Mortgage Bankers Association. Tamara is joined today, not necessarily in the order that they're sitting, by, well, I can do that. To her immediate right, Nikitria Bailey, Executive Vice President of the National Fair Housing Alliance. Brian Green, Vice President, Policy Advocacy of the National Association of Realtors. Yannicka Ratcliffe, Vice President for Housing Finance Policy at the Urban Institute. And Nitria Spatzer, Vice President and Federal Policy Director from the Center for Responsible Lending. I want to thank you all for coming today, and Tamara, I will turn it over to you.
Thank you. And thank you to HUD, OCC, FHFA, and the CFPB for hosting this event. Shining a spotlight on special purpose credit programs is so critical because they can help make meaningful progress in reducing the racial homeownership gap and supporting the creation of generational wealth, which we all know is so important to really making a change in people's lives. We all know that reducing the racial homeownership gap requires an all-hands-on-deck approach with intentional effort by government agencies, lenders, and nonprofits working together to find targeted ways to address historical inequities. This is a moment when we are aligned on these goals. We must take advantage of it. Unfortunately, we can't cover all the aspects of SPCPs that I'd want in this short time, but I encourage anyone who wants to do a deep dive to check out the online SPCP toolkit that the National Fair Housing Alliance, the Mortgage Bankers Association, created in partnership with the Homeownership Council of America. We did this actually as a request by our lenders who wanted to have a tool to help them create special purpose credit programs, and we wanted to be responsive. And so I want to thank those of you all who have used the toolkit and who have actually created those programs. So with that, let's get into specifics. I know we've talked in generalities about why do we need special purpose credit programs, but Nikita, can you kick us off and talk a little bit about that?
Sure. Thank you all so much for the opportunity to be here. Secretary Fudge, Directors Chopra and Director Thompson, and Acting Comptroller Sue. We are overwhelmed with where we are with our nation's homeownership gap today. And we are so grateful for you because you've provided the kind of leadership that we need at this moment. The leadership that really instructs all of us that we actually have the tools to achieve the goals that you all have spoken of this afternoon. The National Fair Housing Alliance is the nation's only civil rights organization focused solely on addressing housing discrimination and creating equitable opportunities. And as Tamara stated, we were one of the early voices making a ton of noise around special purpose credit programs because they are legal. And we work with our council at Roman to produce a paper to really outline how to put these programs together in a way that will comply with our nation's fair housing and lending laws. So we are excited to be here today. And unfortunately, we do have to have this conversation about why we are here and need special purpose credit programs. As the Secretary stated, it's 55 years after the Fair Housing Act has passed. And unfortunately, as we recovered from prior federal housing policies, one of the things that we did was we've not incorporated them in an equitable way. So homeownership is the primary pathway into the American middle class. But as our nation recovered from the Great Depression, we did not do it in a way that was equitable, nor did we do it in a way that was fair. And our bevy of policies, starting with things as far back as the HUD rights system, all the way through to the Federal Housing Administration being put together, incorporated and in fact demanded discrimination. And we set white families up so that they could succeed. And we held whole parts of our nation back from having equitable access and opportunity. And as a result of that, our children today are living in neighborhoods that are under-resourced without the necessary components that they need to thrive. So we're here this afternoon to really talk about why special purpose credit programs are a tool that all of us, Director Chopra, could use to really further our goals to create a shared prosperity and a future in which all of us can be proud that our children will live in. So I want to start there. And I want to say, while we've enacted our nation's historic landmark Civil Rights Act, including the Fair Housing Act, we've never actually repaired. So we have this history of discrimination in housing where we know that today 90% is the difference in wealth between whites and blacks. Whites actually have 90% greater wealth than black Americans, and they actually hold 84% of all household wealth because we made a decision back then to give them a head start. So today we've got to talk about how we need race-conscious policies to actually help build equity as we go forward. And that's what special purpose credit programs do under the Equal Credit Opportunity Act. And we want to thank HUD especially for being so quick in issuing its legal opinion, and for each of the other agencies for joining in its statement, and for the CFPB for providing the type of guidance to really help lenders appreciate how they can develop these programs, because this is the opportunity for action. We know that 7 out of 10 future borrowers are going to be families of color. So this is not about a good thing. This is actually about the health and the financial safety and soundness of our mortgage market, and finally disassociating this false narrative that started back in the 1930s that race equals risk. Those borrowers who were denied access to opportunity, they could have afforded their mortgage loans. So my ancestors, Secretary Fudge's ancestors, who are the result of her living in neighborhoods where she's experiencing appraisal bias, they could have performed well in their mortgage loans. And despite the reality that they could have performed well in their mortgage loans, they were denied opportunity. So we need to utilize this tool to right that and remedy that, and to really bring our mortgage market forward so that it can do what it was designed to do, which is advance opportunity in every neighborhood, in every community across our nation. And if you're a GSE, at the exact same time. So I'll pause there and turn it back over to you, Tamara.
And so can you talk a little bit more about why lenders specifically should be comfortable with SPCPs?
Because I think we've heard from them today. They said, just do it, right? Like, it's like a Nike commercial. You know, like, we've outlined what the tools are, how to put them together, right? I think the CFPB has been very smart in making it clear how we put a special purpose credit program together. It's been very clear that we need to take 2 steps, right? We need to take into consideration the class of consumers that we are leaving behind, that we are not well serving, and then to develop a product that well serves them and brings them in. And then we need to make sure it complies with our existing laws, our Equal Credit Opportunity Act and Fair Housing Act. We've heard from them that when they actually do, those programs are likely to be okay. So we just need everyone to actually take the action and just do it. And I want to point out one quick point here around the Community Reinvestment Act, because one of the things that we do with CRA is we say we're focused in on LMI. We've been doing that since we've enacted housing policy in our country. Since, in fact, before we became a nation, the HUD Rights Act in of itself that invited people to come to these lands, and I won't, get into all the other things that happened because I don't have enough time today, and invited people to come to these lands were policies around low to moderate income people and giving them a leg up. That does not solve for racial inequality in our nation. And here we have a tool that gives us the kind of guidance that we need that leads us forward. It is the guidepost for where we ought to be. So let's just do it and use it so that, again, we are a nation where our children are living in the future that they deserve.
And I'm just going to jump in here. I want to echo your thanks to the leadership here today, and I also want to add my thanks to NAFA and to Nikita for your leadership on this issue. And Urban is working closely with NAFA to bring the value of data to this question of why SPCPs, so that we can. Well, it's clear why you need to do it. In ECOA, Congress clarified that racial targeting does not constitute discrimination if done through SPCPs, provided they meet prescribed standards. The CFPB has made it very clear what those standards need to be in their guidance. A special purpose credit program must be established, administered to benefit, as Nikita said, a class of people who would otherwise be denied credit or would receive it on less favorable terms. I just have to read the quote here. As determined by a broad analysis and pursuant to a written plan. And a written plan must contain information that supports the need for the particular program. So data matters. And that is why Urban, as I say, is working so closely with NAFA to help build the evidence. This data can be used to make the case for SPCPs. It can be used to help design and inform the kind of SPCP you should be doing based on your market conditions and your goals. And of course, it can inform your written plan. And I will mention that there's a webinar that NAFA will be hosting on the 27th. We can send information around to everybody here, and hopefully you'll be able to attend that and see some of the nuts and bolts of that data. But just to remind you all of some of the significant numbers at the top of national level. We've already talked about the fact that the black-white home ownership gap, 30 percentage points today, is as wide as it has been over the last 6 decades. It's also 24 points. The white homeownership rate is also 24 points higher than the Latino homeownership rate, 19 points higher than the Native American homeownership rate, and 12 points higher than the Asian homeownership rate. These differences persist when you control for education and income. Even with associate's degrees or higher, households of color have lower home ownership rates than white households who do not have a high school diploma. And we project, looking ahead to 2040, that some of these gaps will continue to widen into the future if nothing is done to stop these trends, especially for the black home ownership rate, which is at risk of trending further down. And we also know for this audience that households of color remain significantly more likely to be declined for a mortgage than white households. So all these factors can be seen in the national data and specifically in data that we'll be making broadly available. We're also going to make it possible to access this data at the MSA level, and that way you'll be able to see how the different issues persist, whether they're wealth issues, income and affordability issues, access to credit and credit history issues, and how those vary from place to place. So I would add, as Nikitra did, speaking to the research, that programs that are not explicitly racially targeted, such as CRA, have not been fully effective. And we have seen in our research that race and income are not interchangeable terms. They're not synonymous. So until we have explicit targeting through special purpose credit programs, the impacts of the systemic and historical racism that Nikitra talked about are just going to continue to compound from generation to generation. And then, as she said, finally taking a step back, if you look at the demographics and the next generation of homeowners, young households that are more diverse than ever before, this is the question of why SPCPs is really also about the health of the economy, the health of the housing market, and the health of the mortgage market taken all together. That's why SPCPs.
Thank you. Scale has been brought up, and want to talk a little bit about what else can be done, specifically with help from government agencies, the GSEs, the Federal Home Loan Bank. And Mitra, can you talk to us a little bit about that?
Sure. First of all, I want to say I'm so excited to be in this captive room because that I've got you guys here, and we can talk about making sausage, right? Because we all know what the issues are. We understand the impact of racial discrimination and its impact in the housing market. But I think that this conversation in particular gives us an opportunity to talk about how we actually go about moving from just talking about special purpose programs to implementation. And there are a couple of things about that I think are pretty unique, which is one thing I want to say at the jump is one size does not fit all, right? So as we think about special purpose credit programs, we have to acknowledge that even when we're trying to close the African American homeownership gap, it will not be true that a down payment assistance program is going to be the solution. You will have to make your decisions geographically based, looking at the credit data and the denial data as it relates to that particular geography to figure out what the challenge is. Because there are a couple of different things going on, right? When we look at African American homeowners in particular, some have down payment challenges, and that has everything to do with what Nikitra and Yannicka have spoken about so eloquently, the difference in wealth. There's also DTI. Because we have a difference in wealth, people have student loan debt, right? And they have bills to pay. And so because they have less access to wealth, they are more inclined to have those sorts of challenges. And then finally, we have the credit score. And so the reason why I raise all these three different things is that if we're thinking about special purpose credit programs, down payment assistance is a really important part of that. And we're very thankful to the GSEs for thinking about down payment assistance, but it's one tool, it's one lever, and it's not going to be the appropriate lever in every case. So for example, if you were to take a project in Detroit, right? So we're all talking right now, and we're talking about housing affordability. Here's something that's really interesting. In Detroit, there actually is a significant stock of affordable housing, right? And so if you were looking at kind of the credit denials and why you were designing a special purpose credit program, it may not be true that down payment assistance is the answer there. You may have to reach a little bit further to figure out what type of program design you need. And so that brings us to kind of what I think we can talk about regulators doing, which you've already done such a great job, but Fannie and Freddie in particular. And to me, that is designing kind of a secondary market for special purpose credit programs that accounts for all of these different levers that have to be used. Because it will be one thing to do down payment assistance in a particular geography, it will be quite another to figure out whether or not you can look at an alternative to the traditional credit scoring model. It will be yet another to figure out whether or not you're willing to entertain and you've assessed the appropriate risk of a higher DTI. And sometimes, here's where it gets even more complicated, but that's why we're still here talking about home ownership and closing this gap. Sometimes you're going to have to layer some of these things to get at an actual solution. And so I think one of the most important things we can do is talking about having flexibility within our national scope of what special purpose credit programs can do. And then hinting to you as lenders, the reason why we need national flexibility is because you will have to approach your solutions for special purpose credit programs at a very targeted level. You will not have a one-size-fits-all program for your national client base. You will actually have to have a different program or a different offering as it relates to a particular geography. And I don't want to take up all the time, so I'm going to let Nikitra have a moment here to talk about federal home loan banks and the role that they can play as well.
Thank you so much, Mitri. I want to echo what you shared about the GSEs. We actually worked together on a proposal for the GSEs on how they could use a targeted first-generation down payment assistance program. And I want to just quickly state that in that program, one of the most effective things about it is that it would actually help us to really grow homeownership in our affordable programs, where we see a massive underrepresentation of Black and Latino consumers. In fact, if that program is used, we could actually increase the pool of eligible borrowers by 14%. So I want to lift that up. And then we've been running everywhere we could to talk about first-generation down payment. Let me explain to you what it is. First-generation down payment is looking at someone whose prior generation was excluded from homeownership opportunity. We've already talked about that this afternoon. And then it means targeting down payment assistance resources to them. But as Mitria said, we could think about things like small dollar credit programs in places like Detroit, where entire cities and regions are credit starved because there is affordable housing stock, but there isn't the readily accessibility to responsible credit. And in fact, we hear too many stories about members of those communities still getting those types of loans that they got in the 60s that were very predatory in nature. But getting back on point here, when we talk about first-generation down payment assistance based on some research done by the Urban Institute, we know that we can target about 5 million new borrowers. And 70% of those borrowers actually are Black, Latino, and Asian American. And interestingly, they're also a great portion, about 1.4 million of them, who happen to be white. So white people who live in rural neighborhoods who've been hurt by these same policies could also benefit from a first-generation down payment assistance program. And we recommend that this down payment assistance program is administered in a way through down payment assistance, but it could be done in a manner that incorporates other mechanisms, like thinking about things like eliminating, risk-based pricing reliance, or trying to find resources to help with some other way to really help make the underwriting less restrictive for the borrower to ensure they can equitably enter into homeownership. Because one of the things that we're trying to use these tools to do is to really overcome historic barriers. We focused our programs initially on first-generation down payment assistance, because there is not this continuity of wealth that can be passed forward across generations. Some communities can go to the bank of mom and dad because our federal government, our real estate trades, developers, and others have helped create a system to make it possible for some of us to prosper in the system while leaving behind others. The rest of us actually are trying to do everything in our power to save for those down payments, and it takes a long time for people to be able to do that. And the data shows that it's about 14 years, I believe, for someone to really save for a down payment for a median price home today. And then just to the federal home loan banks, we want to make sure they're offering some of the kind of support and information sharing and training of their member institutions to really help them deliver on what we're calling fair and affordable. You cannot talk about affordable today and not ground it in fairness. So we want to make sure the federal home loan banks are actually offering these training and also helping to spread the utilization of special purpose credit programs. And as we heard earlier, some of them are actually starting to do that, and we want to applaud them for that, and we want to see others follow that direction.
So thank you. And I want to go back and talk a little bit about something that was touched on, but I want to go a little deeper, and it's the type of SPCPs, specifically the place-based versus people-based. And I want to talk a little bit about what that means and the opportunities that both present themselves. And Yannicka, if you can start us off.
Sure. I can, unless, Brian, you want to jump in? You've been
Sure.
sitting there quietly.
Okay, let's see. There we go. Well, first of all, I just want to repeat what everyone else has said in terms of our leadership here and the attention you're bringing to this. It makes me really proud that all of you have decided to hold this event and to show your commitment and show that you have people's back if they're going to do this, and that you also want to know what obstacles are out there, such that people haven't taken it up to the extent that we ought to. I also want to say that your leadership has led the National Association of Realtors to also establish official policy supporting special purpose credit programs. So we did that last year at our annual meeting. And that allows me then to come here and give my full-throated support for special purpose credit programs. And NAR, beyond supporting special purpose credit programs, has also supported state associations' efforts. And we do have the state of California that's actually running its own special purpose credit program, which I'll speak about a little later. But first, I just wanted to talk about why I think some lenders have not taken up special purpose credit programs, and what some of my thoughts are, and what I see as potential drawbacks and risks of different approaches. So I think it's quite obvious that this country has a lot of difficulty addressing race squarely and addressing our racial history squarely. And as other people have said, you've got to look at it right in the eye in order to address the disparities. And so special purpose credit programs allow us to do that. The Equal Credit Opportunity Act said it explicitly 50 years ago. And fortunately, HUD, through a general counsel opinion, has underscored that in this century, yes, we can do this. And I still think that there's a lot of reticence, maybe because even if lenders have regulatory support, perhaps they fear the courts. I also think that may be one reason why people who may be committed to it are trying to address it, I think, sometimes around the margins. And I would say that the place-based approach doesn't headlong address race. And I want to speak to what some of the drawbacks are of place-based approaches, despite what may be best intentions. While it may promote investment in some communities, I don't think that place-based approaches are always going to directly benefit people of color. So if a special purpose program is available in certain census tracts, certain communities, if it is not explicitly targeted to people of backgrounds that have faced historical discrimination, it may be utilized by others and may not have as direct an impact as it could. Perhaps if it's directed to an entire city, if you're a large national lender and you're directed to our entire city, that may work. The other concern I hear among many people, including fair housing advocates, are that the place-based approaches could also restrict people of color to certain communities. That, in other words, if you want to qualify for this, you've got to live here, and that it could perpetuate historic segregation or steer people into certain communities. And I think that is one of the greatest concerns I have, based on my past work in fair housing. I also think if you think who the likely population is who would benefit from a special purpose credit program, I think you're also potentially missing borrowers. That you have borrowers who are graduating college, graduating from graduate programs, and who are living in communities with their peers, regardless of race. And a special purpose credit program is saying, if you want to benefit and you want to become a homeowner, you got to move over there. And so that may not be the best approach for one of these programs. And then I don't know that community-based or place-based special purpose credit programs work equally well in targeting different racial groups. That if you're a racial group with a smaller population and maybe not as heavily concentrated in particular areas, trying to get at that without being explicit, may miss that population. So, so in general, I think to the extent that we can deal more directly with race, or if we're going to use proxies, have proxies that are that more closely approximate race, we're going to better serve the communities who've historically been denied credit. Maybe if people are still timid, maybe if you direct it to populations that may come from certain neighborhoods, born in certain neighborhoods, but not limit the use of the benefit, where they purchase a property to communities of color or, specific low-income communities or what have you. Have that flexibility that people can, essentially people who face historical discrimination have the opportunity to use this now to live wherever they choose. And then finally, I think at the end of the day, while people may recognize that they have regulatory support behind this, they may be worried who's going to protect them in the courts. Mm-hmm. And so the more ballast that we can provide, that a special purpose credit program is going to pass legal muster, I think the better. But I think we have to sort of help answer that question, that if people are going to, just go out headlong and design race-based programs, that these will survive legal challenge.
And I'll just add, I couldn't agree more with what Brian says. If you want to reach a certain group of people, now that you've done the analysis and you've identified who the class of people is, you would like to have a program that explicitly is available to that class of people. And so I think that that's ultimately the goal where we want to get to. In the meanwhile, people are using place-based programs. And I think we have a lot to learn and potentially some creativity that comes out of how do you do a place-based program, what happens to the demographics when you do that, and how can you work within the community structure, community organizations to make sure you're getting to reach the right people. And I note that we do have still a fairly segregated country, but it varies from place to place. So I will cite some work that my colleague Vanessa Perry, who is a fellow at the Urban Institute, did on comparing place-based and people-based programs. If you look at a place like Detroit, where 75% of the population is black and fairly concentrated and very segregated, then a place-based program is going to be a pretty good approximation of the actual population that you're trying to serve. But if you look at Seattle, where 7% of the population is black, and they're not concentrated in any particular neighborhoods, then that place-based targeting is not going to be very effective at all. So it varies from place to place, and again, data can, I'm sorry to be an old saw here, but data can really help with that. So for example, if you take a target population, let's just say you were trying to reach households of color, renters of color who are not currently homeowners in LA and Atlanta. If you did something like CRA and said, well, we'll look just at 80% AMI census tracts, you're going to end up cutting about cutting out 40% of the eligible markets just by limiting it to those census tracts. And in LA and Atlanta, you're going to pretty much cut the eligible market in half. At the same time you do that, you're going to basically expand the pool to include a lot of white households that are potentially living in those census tracts as well. If you go to using majority-minority tracts, you tend to get better targeting of your target population. I would say 80 to 85% in both of those markets. But you still have some dilution of that pool overall. So that seems like a good approach. But on the other hand, if your goal was just to target black renters in LA, and you used a majority-minority census tract definitions, you would catch very few black renters. They would make up 10% of your total potential eligible pool. In Atlanta, it would be somewhat better, maybe 30% of your eligible pool. But I'm just trying to throw out those numbers to illustrate that it really does depend on the market and that you need to do your analysis and keep in mind who it is you're really trying to serve and then design the programs. There could be some creative use of people and place-based programs. CRA does this, for example. And I definitely agree with Brian's viewpoint that if you're going to do a place-based program, use the place where the people reside, not where you're restricting their purchase options to. And so I think the important thing here is to track and to learn, and that's an important part that CFPB made clear of SPCP program as well, is seeing the results and assessing the effectiveness of the program as well.
Okay, before I move on to the next one, does anybody else have anything they want to add to this, to Place Place?
I do. Just real quick, the other reason why I think this is really important is something interesting has happened over the past 2 decades, right? And that is that demographics have shifted. So people of color have moved to the suburbs, and even though we have really strong minority populations in cities, there's something else going on here that we need to talk about, which is if we're trying to close the homeownership gap as quickly as possible, then we are looking for potential homeowners who are best positioned to access homeownership as soon as possible. That is not necessarily going to coincide with the demographics that you have in a majority minority census tract. And so you might, in fact, be looking, your most likely potential home buyers might, in fact, be located in the suburbs and not in that minority census tract. And so that is one of the reasons why I think in home ownership policy, we have not been as successful thus far. We haven't kind of done the math, correlating logically what we need to target. So I am not a fan of place-based kind of programs, because I think we've already seen with the Community Reinvestment Act and some other programs that they don't work. They don't work, and they don't work because race is not necessarily the potential individuals that we're trying to attract into these programs are not necessarily going to be located in the geographies that we are targeting. So.
I want to underscore what Mitria said 100%. I mean, my perception of who we're trying to attract are young professionals who are the most likely people to be qualified for home ownership. And I think we would benefit from looking at more data on where those persons are living when they're likely to apply for homes. And so that's why I said if we're going to use geography, maybe geography of where they were born, but not necessarily where they're living and commuting to work. I don't know that they're necessarily going or they're living in some of these communities that are often the targets of programs like this.
And HUD was very specific in helping us appreciate that they can be designed with protected class in mind. I mean, the language itself and its guidance says that special purpose credit programs can be designed to serve a class of persons identified as residents of color who reside in LMI, income census tracts, residents of majority Black census tracts, women-owned small business owners, consumers with limited English proficiency, or residents living on tribal land. So again, we have the kind of instruction that we need for how best to design special purpose credit programs.
Thank you for that. As you can see, that's really a hot spot for all of our panelists.
Tamara, can I just ask if anyone could just build a little bit more? Brian, you addressed the legal, I would call perceived legal risk. What else do you feel have been obstacles based on your lenders or your discussions or others about other things they're dealing inside their financial institution when deciding essentially not to pursue this?
I can't say what's going on inside.
Okay. Well, I know that you're going to have a conversation with the lenders, I think, after this session, and so I'll let them speak for themselves. But in conversations that we've had, I mean, it does take time to build these programs, right? I mean, there is a process that they have to do internally to make sure that they are actually creating these programs as they are supposed to, right? Like making sure that they have all of the data, making sure that they have all of their internal controls. That does take time. For our independent mortgage bankers, that's also, they need to look at the secondary market. They can't hold it in portfolio, so that is something that they need to consider, and how they're going to be working with the GSEs. So those are some of the issues that they have encountered. I know that there have been instances where some of our, like I said, our independent mortgage bankers have been working with Fannie and Freddie to do customized, I'm going to say, programming that is specific to their area, and that takes time. So, I mean, I know, like I said, you will be talking to them individually, because I do think that there is a will, and I will say that we have definitely seen a will and a desire to make changes, to make programs. It will take time, but there is the desire to move forward.
And if I may add, I think, Director Chopra, what we've seen is that there's been some unwise advice given. There's been some scare tactics used. And I think that there are some in the legal industry who don't necessarily appreciate all the nuances of the Equal Credit Opportunity Act and Regulations B's guidance. And they have, in many ways, given advice that's not as reflective of the guidance that the CFPB and HUD have provided. And that's why, we're really excited to be here today to really walk through what you've outlined, because you really have created a pathway to go forward and to do it in a successful manner.
Do we have time for another question, or I know we're bumping up against?
We are bumping up against time. Maybe one more question. I had a question. I really thought that your conversation was very informative and got a lot of things. First, at the point that you made about race and income are not synonymous, and I can't say that enough times. I just cannot. And then the differing needs for SPCPs for different individuals, and with the layering, because we found that even in equitable housing plans, there's a different plan for Black homeowners and renters versus Hispanic. There are different challenges based on, not just the community, but, generational challenges. Some people are looking at, self-employment and the like. We've also found challenges, and I think the Secretary has mentioned this to me a number of times, with small dollar loans, and that's just a huge issue for us. But I do think that, it takes time, but we've had lots of conversations, so I'm really looking forward to putting pen to paper to see what can actually work and get the numbers up. One of the interesting things that we found when we were looking at the special purpose credit programs, and this is that came from Fannie and Freddie, is that the rental payments did not count towards improving your credit score, so a lot of renters were left out. And so we've now incorporated positive rental payments into defining and helping credit score. And the performance, while it's only been a couple of years, or maybe a year and a half, the performance of those loans in terms of how they pay has just been stellar. And so a lot of these fears, because of unknown, is mitigated by data and experimenting and making sure that we're sharing this information. So on the Fannie and Freddie properties, again, you can get credit if you have positive rental payments. And then on the multifamily side, if in many of the properties, if the loan is underwritten by the enterprises, then they do collect for the renters, and they have to opt into it, positive rental payment. But that is not, race-based, that is across the board. And so many people think that they can't afford a down payment. If you look at a $300,000 home, 20% down is $60,000. So let's just say $200,000, $40,000. Who can afford that? 14 years? I don't think so. And you're talking LMI or disadvantaged communities. Nobody can afford that. But these are people that are working hard every day and paying their bills. So we really do need to be thoughtful and creative when we're addressing this issue. And I really appreciate the thoughtfulness that you all have provided for this topic.
Sorry. I just want to say thank you so much, both for, I think it's really, really important every time we have this conversation to remember the historical context, which this situation, for what we're trying to solve for. So thank you for being very explicit about that. I think that's very important. And also that these proxies, they can serve as crutches. And we need to go deeper than that. That's a big theme that I'm hearing that I think is very important. I know that this is something that's been discussed before. I think it's great we're doing it all together. And so I'm really looking forward to doing more of these together, because I think there's some extra power in amplification and reinforcement. And hopefully that can lead to what we all want, which is action and some dollars. So thanks so much.
Thank you.
Thank you.
Well, I want to thank Tamra, Nikitria, Brian, Yannicka, and Nitria for an engaging and wonderfully informative discussion. Thank you so much. And I also want to thank all of the attendees, in person and virtual, for your participation. Now, this was clearly a topic of great interest. As I understand, we reached capacity on the live stream very early in this session. But we were able to add lines during the program, but I do want the group to know we'll post the full video of this roundtable on YouTube as soon as possible, so others will be able to see it. The discussion here today has provided important information and helpful perspective. But at this time, I'd like to invite our principals and their regulated lenders to transition for further conversation. Again, thank you for coming today. This has been a wonderful event. I appreciate all that you shared with us.